Hello, today our team will present a buy recommendation for Cisco over a 1-year period. Our recommendation is supported by analysis of the tech industry, macroeconomic factors, and firm-specific factors, including a valuation showing that Cisco stock is undervalued. Claire will begin with the industry overview.
Okay, so let's delve into Cisco, a global leader in networking and communications technology, known for its wide range of hardware, software, and services in a dynamic industry marked by rapid technological advancements and increasing connectivity demands. Cisco's strategic positioning is highlighted by ongoing trends such as the Wi-Fi 6 upgrade cycle, 5G core deployment, increased bandwidth consumption, and the rising demand for data center solutions. These factors are anticipated to be key drivers for the company's long-term growth, aligning well with the dynamic technological shifts and escalating connectivity needs in the industry. Let's take a quick look at the current industry landscape. Investors in the U.S. technology industry are optimistic, expressing confidence in long-term growth rates. The industry is currently trading at a P/E ratio of 43.7, surpassing its 3-year average P/E of 38.6. Moreover, it's trading close to its 3-year average PS ratio of 5.7. Now, considering past earnings growth, companies in the technology industry have grown 6.7% per year. Concurrently, revenues have experienced a commendable growth rate of 4.6%. This indicates a positive trend wherein increased sales are translating into higher overall profits for these companies. In a sense, Cisco's strategic positioning and optimistic industry outlook position the company well for sustained growth in an era defined by technological dynamism and ever-increasing connectivity demands.
Now, from a macroeconomic perspective, the rate cuts expected next year will benefit Cisco. Cisco has had a dividend yield of over 3%, exceeding the 1.6% dividend yield of the tech sector. This yield will be even more attractive when rates are lower. Cisco stock has generated total returns over 7% over the past 5 years, despite major economic uncertainty from the pandemic, supply shocks, and geopolitical and economic challenges abroad. Cisco will soon be less impacted by these factors as it is shifting revenue away from hardware sales and more towards software services. Overall, this is a value stock that will perform well if the economy cools down as expected next year. Now let's dive into our valuation and beta analysis.
Okay, moving to our beta analysis for Cisco, we have taken a data-driven approach to understand its market risk. We conduct this analysis in Python and Wi-Fi module to source historical daily closing price for Cisco as well as for other major indices like S&P 500 and Nasdaq. Through simple linear regression, we calculate the beta, providing key insights into Cisco's market risk and performance relative to the market. In our financial analysis, we conduct a comprehensive evaluation of Cisco using a free cash flow model. We use a beta 1.13, a risk-free rate of 5.32% with a market risk premium of 5.3%. For our projections, we apply a short-term growth rate of 3% and a long-term growth rate of 2%. This led us to a share value of $66. Comparing this to the market value of $49 per share for Cisco, our analysis suggests that Cisco stock is currently undervalued in the market. This discrepancy shows the opportunity for investment in a company with strong growth rate and robust financials. In our sensitivity analysis for Cisco, we examined the impact of varying long-term growth rate and WACC. For instance, even with a 1% growth rate and 11% WACC, the calculated share price is $55, which is a lot higher than the current price of $49. This analysis is key in assessing Cisco's valuation on different market conditions and emphasizing the importance of monitoring economic trends that could influence these factors. In our disruption analysis, we identify 3 key technological shifts impacting Cisco: the rise of AI in network management, quantum computing, and the growth of cloud computing and software-defined networking could disrupt Cisco's core business model. Now let's go to risk management.
So we identified some things that can threaten Cisco's valuation, but we calculated the value at risk for the stock. We'd say with 99% confidence that the share price will not fall more than 60% in one day. So we shouldn't be too concerned with tail risk here. But as a risk mitigant, we can increase our portfolio allocation in stocks with lower negative correlation with Cisco to reduce overall portfolio risk. For example, in the correlation matrix here, firms like Disney, Starbucks, and Bank of America have a large negative correlation with Cisco, and buying them can allow for diversification. So thank you for your time. If there are no questions, this concludes our buy recommendation for Cisco.